record. Claudia has one job, but I'll do it. No worries. Here we go.
You're a team player, Voltaire.
I know. Now you see his true colors.
All right. Hey, everyone. Welcome to our workshop. Today is 10/10, October 10th, 2024, 6:30 p.m. And I'm excited to be here, even though it's 6:30 p.m. and we're talking about Texas. That those two things kind of don't mix and match. But before I get into the program, if you guys are out there and you have a camera, show us your face, your beautiful pearly whites. It gives us energy. You know, Jesse, he's in his office in Mission Valley. Clyde is in the office in Golden Hill. I'm in my home office here in San Diego, and we need energy. We've been working all day, and so if you can, trust me, you look the same in person as you do on camera. Just show us your face, give us some energy. Thank you so much. So now let's get into it. Thank you. There you are. All right. And then we have Adrian. Okay. And then we have all right. So we got some people jumping on. So now, Claudia, if you want to share a screen,
Yeah.
and that way we could kind of just talk about what we're gonna talk about today. Thank you so much, Alberto. What's up? It's been a while. All right. So if you want to share a screen, Claudia, are you co-host?
Yeah, I am. I'm not getting on the right page. I have two. Sorry, 1 second.
So the cool thing about tonight's workshop, we're talking about tax end of year tax planning workshop for next year. So we're in 2024, and you always want to go back a little bit. We always want to plan ahead. We don't want to just, let 2025 happen.
Sorry.
Yeah. We don't want to just let 2025 happen and then all of a sudden we have all these big tax situations. So here we go. Let's get started. First, let me tell you a little bit about myself, that way you know kind of who's running the show today with my co-host, and I'll introduce him in a bit. But this is something out of LA Times, March 1988. It says, life can come cheap around 30th and Imperial. According to police crime statistics, there is no other location more notorious than 30th and Imperial for killings, shootings, stabbings, assaults, rapes, robberies, burglaries, and a litany of other crimes and assorted mayhem. Police crime analysts say more blood is shed on that corner than anywhere else in San Diego. And when this was written, I was living here. This is the alley I lived in, grew up in, and wasn't easy growing up. And we worked really hard. And now, I'm in a position where I own a lot of real estate here in San Diego. We do a lot of these workshops. We teach, but we've been doing this for a long time. We've been learning for a long time. Can we go to the next one, please, Claudia? So born and raised in San Diego. I've been in real estate since 2002. I'm a full-time residential and commercial broker and property manager. I have an office with about 40 plus realtors that I coach, train, and manage. And I give a lot of money to the community, and I have 54 tenants paying me rent every single month. And I'm sharing this with y'all because anyone could do this, right? Started with nothing, and we grew this and my portfolio over time by learning these things, by learning about taxes, by learning how to buy with little down, how 1031's exchange works and all these things. So this is how we got to that point. Okay. All right. Next slide, please, Claudia. And today it's brought to you by all these associates at Lepe Tendwell Properties. So if whoever invited you to his workshop, reach out and say thank you, give them a good review and say, hey, look at, they put me on and they showed me some good stuff, and now I learned something because of it. So thank you to all the agents who brought this today. Next one, please. And if you want to join future workshops, please sign yourself up. Just go ahead and take out your phone now. You could do that little scan thing. And we talk about tax workshops, first-time buying workshops, home selling 101s, military benefits. We talk about budget your way to $1 million. I really love that class because anyone could become a millionaire if you know what to do with your money. And even if you don't make a lot of money, you can still become a millionaire. ADUs for beginners, renting versus owning, and many more workshops. So today, We have Claudia Lomili, our co-host. What's up, Claudia? She's over there. Say hello. Say hello. We can't hear you. This is first time Claudia's ever using Zoom. Sorry, guys.
I
But
know, no, I haven't co-host in a minute and two screens too much, you know.
all right, well,
But
good.
hi, everyone. Thank you for joining us.
Thank you for co-hosting. And then let's get into the meat and potatoes. By the way, before we get into that, scan and leave us a review. We're gonna put this up at the end. So if you guys learned something tonight, please leave us a review, and that way people in the future know that if you join one of these workshops that you do learn something great. All right, Claudia. Come on, please. And then if you'd like to follow me on social media, you can. There's that. And do we have Jesse's presentation, or is he sharing his own?
I'm gonna share.
Okay, cool. So let me introduce Jesse Lipscomb. Jesse Lipscomb has been working side by side with me for many years now as a tax advisor. He's been, looking at my tax situation. When I first started with Jesse, it was just like a complete mess. And then he taught me how to do better. He taught me how to get in a position to where I don't pay as many taxes. When I first met Jesse, I was paying a lot of taxes. I was unorganized. Nowadays, it's all about tax planning, like what we're going to be talking about tonight, and how to minimize taxes. And if anyone out there is, making good money, and you want to keep more of that money, that's what we're going to be talking about tonight is tax planning. And then he also saw what I did in my business, and then created a strategy around that, and really helped me keep a lot of my money over time and just make more money. So Jesse, welcome tonight. I know it's
Thank you.
I know it's a late night. Thanks for joining us, and thanks for being here to teach us.
Yeah, no worries, brother. Claudia, are we share? We got the green light?
Claudia, I don't know if she's on mute, but here.
I am, but yeah,
you-
because Voltaire started the Zoom call. I don't, yeah.
Cool.
We're good. We're good. We're cooking with the
Good.
gas. We are ready. All right. So you guys see everybody see the screen 2024 year in tax planning?
Yes, yes.
Right. This is I can't take look, I can take credit for 2024 year in tax planning. Tips, tricks, and politics. That's all Voltaire. All right.
Yeah.
So that's pretty cool. All right. So hey, Jesse loves Jesse's screen. What makes me kind of special in this industry is I'm an investment advisor that became an enrolled agent. What does that mean? Enrolled agent is a license from the IRS. I don't even look at taxes like a normal CPA does because I'm coming from a planning angle. The fact that we specialize in tax planning for real estate agents and real estate investors has really made my business thrive. And I encourage you guys all to have a niche. So bottom line, we're going to talk about three things tonight: some fundamental strategies, an objective, apolitical look at the presidential proposals. If you were at Coffee and Cash yesterday, you got a glimpse of this, and then some action you have to do, required steps you must do by the end of the year. Okay. If anybody has any questions as we're going through this, Voltaire, if you can check the messaging pop-ups, or if you just want to unmute yourself and say, hey, what are you like? I'm talking about something that I talk about all day long, every day, and I'm happy to answer any questions as we're going through. Okay. But our fundamental strategies basically boil down to these three steps. Depreciation is the most powerful tool you have as a real estate investor or as a business owner to lower how much money you pay in taxes. I'll explain how it works in a minute, but just know that depreciation is your best friend. If you are a service professional, you're a real estate agent, you're a handyman, whatever it is, if you're an independent contractor or a professional and you make over $60,000 a year, you're getting eaten alive by Social Security and Medicare taxes, and an S corporation can help you take control of those taxes. Notice the words, control those taxes. If anybody ever tells you a corporation eliminates all your taxes, they're overselling it. The last part is Whereas I believe you invest for cash flow in your business and real estate, a lot still has to be said about purposely saving for retirement, utilizing, um, you know, employer-sponsored retirement plans. We'll get into what that means here in a minute, but these are our fundamental strategies. So let's talk about depreciation. IRS Pub 946 says depreciation is an allowance for the wear and tear, deterioration, and obsolescence of property. What does that mean? Simple. Look, anything you buy, doesn't a house that's 30 years old need some TLC? Of course it does, right? From the paint to the roof to whatever. And the IRS just says, well, listen, we're going to give you, for tax purposes, a wear and tear allowance based on what property it is. Accelerated depreciation is wonderful. It's designed to stimulate investment in business and real estate and has the opportunity to create tax losses that can offset your other income. If you made $200,000 in self-employed profits or S corp profits, and you had $200,000 of depreciation, boom, wipe that out. You don't pay any taxes. And the last part of that is we're going to talk about the three, I would say, most common depreciated assets. You guys be the judge. All right. So vehicles, equipment, and real estate. Why does real estate have an asterisk on it? Because whereas vehicles that you use for your business and equipment that you use for your business, they're there would be considered personal property, right? They're not real estate. There's no other aspects of these types of property. But real estate's unique because it has both land and improvements.
And
Every
real
single,
quick, if I could stop you,
yeah,
because I have a question, because for a
Yeah.
long time, Jesse, I didn't know what depreciation meant. And
okay,
even after many years in real estate, I still didn't know what it meant up until, I really started tax planning.
Yeah.
And what I found out that it meant was everything that you own is going to depreciate down to zero at some point in time. So like
yeah.
this iPhone that I have right here, at one point in time, it's going to be worth nothing, right?
Mhm.
Right now, it's a iPhone 12, and I don't know, maybe like in, I don't know, 7 more years, 5 more years, it's going to be obsolescent, or it's going to be worth, like, nobody's going to want to pay
It's
me.
already worth nothing.
Yeah, it's probably worth it's worth a couple $100, I think. Somebody in a third world country might, that you could sell them over there for more. But I would say at one point in time, Jesse, this phone's going to be worth, like, no one's going to even offer me $1, right?
It's true.
So,
I mean, it's true.
so that's really what depreciation is that over time it depreciates to zero, including a car depreciates to zero, a house in theory depreciates to zero, because it could get in such bad condition that it won't be worth anything. So
Yep.
that term, I just wanted to say that, because there's a lot of people that don't know what depreciation is, and I just wanted to make it clear.
Well, and to add on what you're saying, what's unique about real estate, and this is why I put that asterisk there, is that all of real estate has land. Okay?
Yeah.
Land doesn't wear out. The dirt doesn't wear out. So unlike a cell phone or a car where you can depreciate the entirety over time, you can only depreciate the improvements of the property. Okay. So let's go through an example. Just normal depreciation of real estate. You've got a $1.5 million property. The assessor says it's the land's worth $500,000. Therefore, the rest of it's worth $1 million. Pretty easy, right?
Right.
Now, normal depreciation of real estate is 27.5 years residential. So if you divide $1 million divided by 27.5 years, you get $36,363 a year of annual depreciation.
And
Okay?
it's 27.5 years. Why?
I don't know. That's what the IRS says.
So the IRS, this is an actual law that the IRS says, hey, look, if you got $1.5 million property, you could depreciate it to help you pay less taxes, or in your words, control your taxes.
Amen. Yeah. I mean,
Okay.
the standards with the IRS, it's 27.5 years for residential, and it's 39 years for commercial.
Got
Why
it.
is that? I don't know. They made it up.
Got it.
But if we dig into this, what does this tell us? If you bought a property, this property, for cash, you wouldn't have a mortgage. Okay. So you could write off as a rental, you could write the property taxes off, any improvements and HOA insurance, right?
Right.
But in addition to that, the wear and tear allowance, the depreciation allowance of that $36,000 can neutralize that part of your income. So really, the first $3,000 a month of rent of this property is tax free to you because the depreciation eats up all of it.
So someone, Joel wrote, I need $1 million property. So does this mean that only if you own $1 million property, you could depreciate, or is it,
No, no, no. I literally just did that for easy math.
this is an example. So you could own any property and depreciate it
Yeah, yeah, absolutely.
if it's a rental, right?
That's exactly right. If it's a rental.
Okay,
Yep,
cool.
yep.
So get yourself a rental, and then right now you're gonna figure out why this math makes sense to your pocketbook after Jesse's done explaining.
Yeah, absolutely. So I'm sure you guys have heard of cost segregations. Okay. Like, well, what is that? Picture any property, any building. There are the structural components of it, the walls, foundation. Then there's the non-structural foundation, non-structural aspects. What about the sidewalk and the fence and the windows and the doors? It's non-structural. And the IRS actually gives us 5-year, 7-year, 10-year, 15-year depreciation schedules for those non-structural improvements. The beautiful thing about this is a cost segregation is just an engineering study. You pay for the engineering study and it'll break down the property in terms of its land value, structural and non-structural components. And then you get to look at what bonus depreciation, also called accelerated depreciation, does for you. Same property after a cost segregation determines that $700,000 is the structural components of the property and $300,000 are not. That means that you can accelerate that 300,000. Now in 2024, it's 60% accelerated depreciation. So you take 300,000 times 60%, it's $180,000. The 700,000 will still give you 27.5-year depreciation. So add these together, and now you get to write off $205,000 of depreciation. That also means the first $200,000 that you earn, you're not going to pay taxes on. Everybody tracking? Does this make sense? This is how the rich get richer. People get angry about Trump not paying taxes. He doesn't pay taxes because the guy's got depreciation carryover losses that wipe out his other income. He's just playing the game.
So basically the IRS, why would the IRS allow a rule or make up a rules for depreciation if you own rental properties? Why do you think
Great.
that?
Well, very specifically because it's not just real estate, it's real estate and business. It's designed to stimulate investment in business and real estate. Right? It's like the more. Think about you building an ADU. Okay? It may take $100,000 of your capital to build an ADU worth $300,000. Okay? But where'd that $100,000 go? It went to Home Depot, it went to the contractors, it went to the city, it went to the architects, whatever. And then when that property is worth 300,000, what happens? Well, now you pay higher property taxes on it. When you sell it, if you don't do a 1031 exchange, the IRS is your silent partner in the deal. Right? So the opportunity for business and or real estate investors to put more money into assets for their business, that's in everybody. Like all ships rise in a rising tide. right?
And then to add on to that, what I found out is that every time a real estate transaction happens, anytime somebody buys or sells a home, there's over 50 different individuals that get paid or make a living off of that.
Oh yeah.
There's an escrow rep, there's a
Mhm.
title insurance, there's a lender, there's all the loan assistants, there's a realtor, there's a notary, and then there's the landscaper, the termite guy. There's all these people.
Yeah,
So
yeah.
it makes sense that the IRS says, hey, if we encourage people to buy real estate and buy business things
Mhm.
by lowering their taxes, then we're gonna do that because it pays everybody else. So this is
Yeah.
a nice, trick, I guess, that a lot of rich people use to keep more money in their pockets. So, but they need to buy an investment property or a business type of thing in order to do that, right? They just can't do it on their private
Yeah,
residence.
I think that's the number one mistake people make, actually, is when you go from being a W-2 employee to being a self-employed person, and now you're starting to make more and more money. The habit for most people are to put that additional revenues into their primary residence. They're gonna, oh, we're gonna redo the kitchen, the bathroom, the whatever, because they wrongfully understand that putting that money into their primary residences is going to make the house so much more valuable. It may or may not based on the market, but there's zero tax benefits for it. Matter of fact, there are disincentives. Why? Because you're using after-tax money to put that money into the house. Okay. On the flip side, what if you put $300,000 as a down payment on this, and now you're getting a $205,000 write-off?
Hmm.
That's tremendous. I actually used a strategy like this for a lady who was in her 70s who'd invested in real estate for quite a long time as a way to offset her required minimum distributions. I said, if you're gonna, we looked at her portfolio and her distributions were gonna be pretty high. I said, well, if you take out $300,000 a year and you buy real estate with it, you will basically use accelerated depreciation to wipe out the taxes on your IRA. And so Alberto has a great question. He says, does the accelerated depreciation only apply to an S Corp LC self-employed? It can be used a W-2 earner. So it's easy to use on businesses. It's less easy on a W-2 earner only because unless you're in the real estate trades, your ability to lose money in real estate's limited. Okay. I'll give you an example. Well, let's go back to this one. This $36,000 is $3,000 a month. Let's say that you rent the property out for $5,000 a month and you have $2,000 a month of regular expenses. So $5,000 minus $2,000 is $3,000. The $3,000 a month of depreciation will wipe out the taxes on that income. It doesn't matter if you're W-2 or otherwise. However, let's say regular W-2 and you try doing the cost segregation, that $205,000 is not going to be able to come out and offset your income. So Francisco says, let's just say a family member and I start buying rentals together under a trust. Since I'm a realtor, could the family member I'm buying the properties with also use the write-offs of their income if they're not a real estate professional? So Francisco, I understand your question, but it actually doesn't work that way. So the way it works is this. Watch this. You wouldn't buy the property in a trust per se. You'd have it in a partnership, even if the partnership owns the trust. But look at this. Here you got your partnership tax return. In a partnership tax return that owns rental real estate, you're going to use an 8825. This is just like a Schedule E, but for partnerships, right? You've got the property, you've got the rents, you got the advertising, all the expenses. Okay. At the end of the day, if you have a loss on here, Okay, you notice that we've used all the expenses. The expenses do not factor in whether or not you're a real estate professional. It's just your ability to use those losses is limited if you are or are not a real estate professional. Does that make any sense?
So basically you said he could use it for his taxes, but his family can't use it for theirs? Is that what you're
If
saying?
that family member is not a real estate professional, that is correct.
All right, okay,
Yeah.
cool. So you're,
Yep.
you know, okay.
But you also see how it doesn't, being a real estate investor or not, real estate professional or not, has no impact as to what you can write off or not.
Got it.
Okay. All right. So I put this slide in as the last slide of depreciation, just to explain that under the Tax Cuts and Jobs Act, from 2018 through 2022, we could do 100% bonus depreciation. That was wild, man. That was really powerful. Last year was 80%. This year it's 60%. Next year it goes to 40 and then 20 and then back to not accelerated. It doesn't mean you're losing depreciation. You're just losing the velocity of money, if that makes sense.
I want to use an example of I think a lot of people have heard this. If you buy a 6,000 pound car for business,
Yeah.
you could depreciate. So a lot of people are buying like G-Wagons and Range Rovers and
Yeah.
all these nice cars, because if that car cost them $200,000
Mm-hmm.
and there's 100% bonus depreciation, that means that the car, if they're using it for business, they could depreciate the entire 200,000 against their income. So if they earned in the year 2022
Yeah.
$200,000 for the year, and then they bought themselves a nice Range Rover worth 200,000 or a G-Wagon, all of a sudden they made zero in income,
That's exactly right.
and then they paid zero in taxes. So that's the power of 100%
Yeah.
bonus depreciation. And then if you bought a car in 2023, then you go down to 80% of that
Mm-hmm.
200, and then 60% of that 200, and so on and so forth. Okay, cool. I understand it. Does everybody else
Right.
understand this? Adrian says he's getting a new car right now. No, Adrian, you're not getting your.
Right. Hey, Voltaire, I hate to do this, brother, but it looks like the building alarm went off. I gotta turn it off. I'll be right back.
All right. All right, let me take over.
All right.
Let me get your slides. I don't have his slides. All right. So hold on a second. Continue. Yes. Let me do this. Let me share my and then I'll stop that. All right. All right, guys. All right, so his building alarm went on. He's gone. Hopefully he'll be back in a minute or so. But let me share with you this. I started using this technique, depreciation, against my real estate, and I haven't paid taxes to the IRS in several years because of this. And it's genius. It's the IRS encourages it because they want me to buy real estate. They want me to spruce up the economy. So they incentivize me by saying, hey, we're not gonna, you won't have to pay taxes if you do this, which is an amazing thing. So I highly encourage it. And I also bought a vehicle, same thing. This is how the rich get richer. Jesse's back. All right, Jesse.
Hey, Voltaire, you know what my favorite strategy is? Not my favorite, but one kind of like a favorite is? For those of you that are not real estate professionals, it is buying an RV. I love that strategy because an RV is not passive. Okay, so I'm going to draw this because it'll make more sense. There are three types of income. Okay, you have earned income, which is what? It's your W-2 wages. Okay, W-2 wages and net self-employed earnings. Okay, it's earned. It's subject to Social Security, Medicare, but it's earned. And then you have passive. Okay, a lot of different things here, but basically, this is where we got our real estate. Okay, and then you have portfolio. Okay, we're gonna leave that alone. Stocks, bonds, mutual funds, whatever. But net self-employed earnings can be a loss. You could make $100,000 a year W-2, and just for easy math, let's say that we've got 100% bonus depreciation 2022 again. You could buy an RV that you're going to rent out on RVshare.com, and you could pick up that RV, that $100,000 RV on December 30th. You've put it into, you bought it with the purpose of renting it out, and now that depreciation allowance completely wipes out your income. And you can do the same thing on a vehicle with two-row. I mean, you guys doing what is that called? Uber and Lyft. You got yourself a $60,000 Suburban. Boom. It comes right off because it's a business expense, right? So earned, the only way W-2 can get their income offset is through depreciation of business assets. Real estate, it's going to be capped if you make more than 100 grand a year, and nothing if you're over 150. So interesting, huh?
Yeah, and then Joel has a question. So if I understand correctly, this method works only if I was to purchase a rental property.
No. Not correct.
Meaning, I think he's comparing it to a primary residence.
Oh, yes. You
Yeah,
only get depreciation on business assets. A
business.
rental property is considered a business asset. At this point in our presentation, we haven't talked about whether you need to be an LLC, a corporation, whatever. It's call it a for-profit venture.
Profile. Okay, I like that. It's like, or a hustle, whatever it is.
There you go. Yeah.
Whether you're selling, tamales out of a truck and you buy the truck for the tamales, or
For real.
whether you're a realtor and you buy a car so you can go show properties, that's a business venture or for profit, right?
Yeah.
Cool. But what a lot of people do is they have their house, they move out of their house, they buy another house, and then the first house, they rent it out. And now
Yeah.
they can start depreciating the house they used to live in because now it's a business venture for profit. Cool.
You're absolutely right. Yep.
Thank
So, but I'm telling you, depreciation's your best friend. Depreciation can be a game changer. Okay. The next part of our conversation here is really focused on self-employed people, professionals, real estate agents, insurance agents, contractors, people that are self-employed 1099 making over 60 grand a year. Okay. An S corporation is all about controlling and lowering your taxes. So what is this? This is a pay stub. What this says is for every $1,000 that you earn, $76.50 or $7 or 7.65% goes to Social Security and Medicare. Okay. Before you ever get paid, boom, it's there. What you may have never seen is that whereas 7.65% comes out of your paycheck, your employer actually has to match it. And when you have the intestinal fortitude to go out and become self-employed, the IRS says, well, congratulations. You are now your own employee and employer. Now you get to pay 15.3% in self-employment taxes.
That's
Okay.
crazy.
Not only is it crazy, it's painful because in my experience, now this is not 100% rule, but this is a commonality. When you're an aspiring real estate agent, you might start off part-time. You might, start getting maybe you got another job while you're doing that. Maybe, you make $30,000 in the year and you write it all off so it doesn't really hurt you. Or you do that depreciation on the car and actually helps you. And you're like, oh man, being self-employed is awesome. And then that first year, you really kind of break out and you make $100,000. Okay. 100,000 profits. Not only are you in danger of getting in from now the 12% bracket to the 22% bracket to the 24% bracket, but now you got 15% Social Security and Medicare taxes on top of it. And it stacks. So you're looking at sometimes 40% of your income in taxes. And because you're coming from being a W-2 employee where you already had withholdings, most people get shocked at this point. And they're like, oh my God, how am I going to pay those taxes?
So
Right.
basically, if you're a professional handyman, professional insurance
Mhm.
agent, a realtor, you're gonna pay 15%.
Over and above your income taxes, over and
Oh,
above.
holy crap.
Yeah,
Okay.
it's unhappy. And the worst part of it goes up to $168,000, which means the first $168,600 that you earn is assessed the 15.3. Okay. So how do you calculate self-employment tax? Let's say your profit was 72,000. You made 100, wrote off 30, 72. The IRS gives you an adjustment because corporations get to write off what they pay for the employees. So you get an adjustment there. And then after that adjustment, it's 15.3. So on $72,000, you're paying 10 grand in self-employment tax. Okay. Now, if you think about it, there's wages and self-employment, and then there's pass-through like S corp profits. And if you add them all up, that's your total income. And you can see in this situation where you've got $72,000 of self-employed profits, you're paying 10 grand just in Social Security, Medicare, self-employment. Check this out. If all you did was pay yourself as a corporation, it's the same $72,000, but instead you paid yourself wages of 24,000 and took profits of 48,000, right? 24 and 48, 72. You'll only pay Social Security, Medicare taxes on the $24,000. The difference is $6,500 a year. That's over $500 a month that you save for doing what? Boom. Like nothing changed. You just set up a corporation. You just took control. Okay.
Like how much does a corporation cost to set up?
$1,099.
There you go. So you spend $1,100 and you save every year after that 30, I mean
Dude.
$6,600 or whatever. That's crazy.
Let's take this to the next level.
Yeah.
Okay. Because if all you're going to do with your corporation is lower the amount of Social Security and Medicare taxes you're paying, honestly, you're missing a monstrous opportunity. And that monstrous opportunity is pairing your S corporation with your own retirement plan, your employer sponsored retirement plan. Okay, so let's take a look at that. Let's just do a solo 401k, something easy, real straightforward. You're saving $6,500 a year in taxes for 10 years. That's 65,000. You're doing it for 20 years. That's 130,000. But it's not. It's the $130 you didn't pay in taxes, and it's the $130 you saved for yourself. That's over $250,000 swing. You were going to pay these taxes anyway. You might as well save them for yourself. And then you learn this rule. $500 a month, 5% interest, 20 years. Again, $500 a month, 5% interest, 20 years. It's $205,000. It's 200 grand. Well, I don't have $500 a month to invest. Yes, you do. we just took control of your taxes and found it. So, Jesse, what you're trying to tell me is not only am I going to pay $130,000 less in taxes, but if I take $500 a month and make 5% over 20 years, it'll be worth $205,000. That's exactly what I'm saying. That's exactly what I'm saying.
Now you're speaking my love language. I love this.
Yeah. And by the way, why do I say 5% instead of 7% or 10%?
Because you're safe. That's a safe rate.
Because it's real, And this actually, it's interesting. I for 1 second I said invest 500 a month. I want to erase that from the record, and I want to say very precisely save $500 a month. A belief system I've been developing this over the last 20 years is the following: save for retirement, invest for cash flow. What's the difference? Investing is a contact sport. You got to be involved. You got to learn how to evaluate risk. The more education, the more experience you have, the better. But your investments, whether your business or your rentals, that's your baby. You gotta be in that. And as you're in that, you'll invest for cash flow. Setting aside $500 a month long term, uh, that's long-term savings. Well, what if it's in the S&P 500? Well, that might have a little bit more risk reward than if it was just in a money market account. But don't equate rate of return to whether something's a savings tool or an investment tool. Okay. So now we're okay. So you've set up an S corp. Your corporation, your business can sponsor the 401k. This year you can put 23 grand a year away if you're under 50, 30,500 if you're over 50. Plus the business can put in an additional 25%. For you real estate agents out there, have you ever known anyone gone through a hard time in their business where they didn't make sales for a couple of months? I've seen it happen. The worst possible thing you can do is go out and cash in your IRA, because you're going to get a 10% early distribution penalty. You're going to end up paying 22, 24, 32% taxes to the IRS and 9.3 to the state of California. And if we just add that up, 10% penalty, 9.3 California, what is that? That's 19.3, right?
Mhm.
Add 22% to that, you're over 40%. How are you going to get yourself out of a financial pickle if you end up losing 40% of your retirement savings in taxes? What if you just did this? What if you took that old IRA, that old 401k, and you rolled it into your business's 401k? The rules are you can borrow half of it up to $50,000 tax free. Now, do you have to pay it back? Yeah, you got to pay it back. Who do you pay back? Your 401k. You're paying yourself back, right? So I'm saying if you're ever going through a bad time and you're self-employed, definitely consider setting up a 401k, rolling over old money into it, and then borrowing that from yourself as opposed to doing taxable distributions. And I'm not saying that a 401k loan is the best thing ever, but it sure beats paying 40% in taxes.
Yeah, and I'll just speak to that. We have a lot of clients that borrow from their 401ks and they buy properties. So if you have a solo 401k, you're a professional, you can do the same thing. And it's what we teach our clients to do all the time, which is nuts because we don't do it ourselves. Um, Eamon has a question. If I'm a W-2 employee, do I ask my employer to pay me to my S corporation?
You know, that's a great question. California's AB 5 law, which, since I'm not an attorney, I can't give you legal advice. I can just tell you big picture what happens. Hey, AB 5 is basically made, with very few exceptions, everybody a W-2 employee. But the exceptions is where you can really hit the home run. Are you a licensed insurance agent? Are you a registered rep of a broker dealer? Are you a real estate agent, right? Are you a licensed contractor? Like, if you have a state license, generally speaking, you can set up your own business. If you're currently like at a car dealership and you're selling cars, the reality is you're a W-2 employee. The dealership has to pay you as a W-2 employee. Okay. So
I know he works at a hospital, so I don't know if that makes a difference.
if he's a doctor, he could set up a professional corporation. If he's not, he might not be able to. It just depends on what he does.
Okay. Thanks.
Yep. Okay. So most of you have heard of a SEP IRA, and there's a misconception out there that it stands for self-employed IRA. It actually doesn't. It stands for simplified employee pension. But the point here is you're going to notice that you can put 25% of your wages into either plan, either in 401k or a SEP, doesn't matter. Okay. The difference is, however, Inside of a 401k, you can contribute as your own employee. So look at this. You're paying yourself $72,000 a year in this example. You can pay $30,000 of salary deferrals plus 18,000 employer contributions. You can put $48,000 a year away in your 401k versus only 18,000 in the SEP. What's the point? It's getting more money in quicker to help you lower your tax brackets. Using the same example from before, $24,000 in wages, 24 grand in wages in a SEP, you can only put away $6,000 into that. But inside the solo 401k, you can do 6 plus another 18. So 100% of your wages ultimately go for retirement. Okay. These are the tax brackets. One of the most impactful things that we do at Roadmap Tax is we try to do tax bracket planning or optimization. Okay. Well, the only way we can do that is by knowing what bracket you're in. So here's some kind of insight. If you're single, making less than $47,000 you're taxable, or 94,000 married, Roth IRA, if you're trying to save for retirement, Roth IRA, Roth 401k, or even doing a Roth conversion, that's a good strategy because you're only in the 12% tax bracket. You're not going to ever pay lower taxes than that. The flip side, if you're in the 32, 35, 37% brackets, which unfortunately hit at about 200,000 single and 400 married, you start getting into the Looney Tunes brackets here because that's just federal, right? So you add state. Now, again, how do you get ahead if you're paying 40% of your income in taxes? The defined benefit plan. Remember earlier I said that a SEP stands for a simplified employee pension. Think of a defined benefit plan as a complicated employee pension. Okay. You're gonna be able to put crazy money away. Here you got somebody that has a 401k. They're paying themselves $150,000 a year. They're putting 30 away in plus 25%. They got 67,000 a year going to retirement. Inside the defined benefit plan, they could put a total of $200,000 away. Okay. I've got a client right now, 60 years old, makes really good money, had nothing set aside for retirement. He's putting away $300,000 a year into his defined benefit plan. He's saving almost $150,000 a year in taxes. And in 10 years, he'll have a pension far in excess of $3 million. And that's even at 0% return.
That's crazy.
In this case, this guy's saving $76,000 in taxes. And in the example I told you a second ago, he literally had the 300 grand in the bank. And he literally moved it from the bank making very little to saving $150,000 in taxes. I mean, that was the best check he ever wrote, you know? So.
And by the way, we got about 10 minutes left. So we might
Perfect.
have to do a little
Perfect.
speed round.
Ah, this is perfect. Because we're just going to go thumbs up, thumbs down for this part. These are the presidential proposals. They're not designed to be political. I mean, yeah, they're not designed to be political. It's just factual. The candidates themselves have proposed this. Okay. President Trump has proposed increasing bonus depreciation, accelerated depreciation back to 100%. Vice President Harris has not addressed this. She has proposed increasing corporate taxes from 21% to 28%. President Trump has proposed decreasing it from 21 to 15. What are the consequences of that? Well, if you raise corporate taxes, you're going to cause a ray in consumer pricing because the corporations are going to make their profits regardless of the tax rates. Okay. Her proposal also is to raise capital gains from 20% to 28%. President Trump says, let's keep it at 0, 15, and 20. If you're a real estate investor, the 1031 exchange continues to be your best strategy here because it doesn't matter what the capital gains rate is if you're deferring all of the taxes. Clean energy.
And by the way, just go back to that capital. Yeah. So this is for somebody, let's say you own 2 houses. You bought one in 2000, you lived in for 15 years. And then 8 years ago, you called your realtor, or 9 years ago, you called your realtor and you said, hey, I'm ready for a new house. and then you didn't sell the first one, you just move into the next house in 2015, and now you're living in that house, and you have a renter, and you've had this house for 24 years now because you bought it in the year 2000, and let's say it's worth 800,000, and you only owe 200,000 on it. You say, you know what, I want to grab some of that money. Capital gains means if you sell that property for 800,000, on the gain that you made on the property, because you bought it for 400 and you sell it for 8, you made 400,000. You're gonna have to pay tax
Do
on
quick math, 30%.
30%. Yeah,
So $120,000 for nothing,
120,000. And then so
right?
the proposal is saying that they want it, she wants it to go up, capital gain.
Yeah.
So
Yep.
it'll affect real estate owners or investors and people that just have stock as well. Okay, sorry.
Yep, no worries. Clean energy, Vice President Harris proposes no changes to the Inflation Reduction Act. Basically, we're talking electric vehicle credits. President Trump has proposed eliminated most of them. I don't think this is going to impact most people either way. This right here is the most, I don't want to say controversial. I want you to understand that you don't want what this says. A billionaire tax on unrealized gains, meaning a tax on billionaires on money they haven't seen yet. You put $100,000 into an ADU, it's worth 300. You haven't done anything other than invested into it. You got a $200,000 gain. This would put a 25% tax of $50,000 on that for nothing. And the reason I say this is a dangerous proposal is that it's sold as a billionaire tax, but as soon as it's in the code, it's going to become a half a billionaire tax, a quarter of a billionaire tax, a millionaire tax, and then you're going to pay it. And because why do I know that? That's exactly how they sold the income tax in 1913 as just a millionaire tax. It won't affect anybody.
So you're saying back in the day we didn't pay income taxes. It was just million.
Income taxes in America were deemed unconstitutional until somehow they became constitutional in 1913.
Got it.
Okay. Taxes on Social Security. Vice President Harris hasn't addressed this, but President Trump has actually said, let's eliminate taxes on retirement benefits, Social Security. Interestingly enough, California already doesn't tax Social Security retirement. And then the Affordable Care Act, the Vice President is in favor of extending the subsidies for health insurance, and he's in favor of repealing it and replacing it. So those are the proposals. Here are your action items. These are gotta have happens by 12/31. If you want to utilize depreciation, you need to acquire the asset and place it in service by the end of the year, whether you're buying a vehicle for your business, equipment for your business, or investment real estate. That needs to happen by 12/31.
And what is it this year again? What percentage?
60% accelerated.
Okay, 60% accelerated. So if you bought a property this year, that's an investment, you could use 60%, or like he said, a business asset. Okay, cool.
Yep. If you decide to incorporate, that's cool. It's got to be set up and ready to go. But also, if you want to take advantage of these big tax bracket savings in the retirement plans, you got to make sure you run your payroll. You got to have wages in order to put money into a 401k or a pension plan. Okay. The last thing, this is huge. I'm saving the worst for last, not the best, the worst. Okay. The CTA is the Corporate Transparency Act. It has been deemed unconstitutional, comma, you still have to comply with it. What? Yep. Okay. The Corporate Transparency Act applies to all entities registered with the Secretary of State, whether it's an LLC or corporation. It doesn't matter if it's taxed as a partnership, S Corp, C Corp. If you have an LLC or you have a corporation, you must file informational return with FinCEN, the Financial Crimes Enforcement Network, by December 31st of this year, if it was in existence before the end of last year. If you set up an entity this year, you've got 90 days to make that change. And if you don't pay attention to this, if you think, oh, it doesn't apply to me. When I put this slide together, the penalties were $500 a day. Yeah, that's per the Corporate Transparency Act. Well, they've got an inflation write-up in there. It's actually $599 a day, up to $10,000 in total penalties, and up to 2 years in prison for failure to file these. So, guys, if you've got an LLC or a corporation, be sure to file this because it's an onerous, unforgiving deal. All
That's
right.
pretty wild. I've had a corporation since 2005, 19 years now, and I never had a.
Yeah.
This is new. Yeah.
Yeah, man, this is brand new, and I mean, it's evil. Here, look, you can. We obviously we charge to put these together for people, but if you just FinCEN, okay, the Financial Crimes Enforcement Network, file a report using the BOI or file the BOI. Okay, here we go. Like, you have to do this. This is the law. And failure, well, I didn't know. That's not an excuse. You got to
Yeah.
do it. Okay.
Oh, thank you.
So, all right. Last bit here, quick recap. What did we do? We talked about the fundamental strategies of depreciation, incorporating and sponsoring a retirement plan. Kind of went through some of the presidential proposals and your action required by 1231, which again is get that vehicle, equipment, or real estate, put it in service, incorporate and run payroll, and file your beneficial ownership report with FinCEN. Some free articles here: tax plan for the self-employed, tax return for realtors, the individual 401k. This, I felt so cool. I had my Voltaire vibe going yesterday morning. All right. First time I've ever used a QR code in my entire life. But this, I put together tinyurl.com/2024YETP, year-end tax planning.
Throw it in the chat.
Okay.
And so if somebody goes on here, what are they going to get? These things?
I can type
gonna,
it.
thank
There
you.
you
They're going to get all of the above articles,
Okay.
plus they're going to get information on the presidential proposals. Full disclosure, I didn't put these together, right? These are, I did this to communicate them, but actually Spidell, they do continuing education for the tax industry. I actually attended a workshop last week on that, and have permission to share it, so I'm sharing it.
All right.
All right, man, that is it.
Cool. All right. So let's wrap it up here. Let me do this. There we go. All right. That was it. 1 hour on the dot. We're talking about taxes on a Thursday, 7:30 p.m. You all should just pat yourself on the back because, man, taxes in the evening after work. Hey, what's up? Hey, thanks for letting us see your face, and everyone else for attending. Francisco, what up? This is really important stuff, and it can really change your life. I wish I would have done this a lot sooner, just like, a lot of people wish they would have bought real estate sooner, started investing sooner, and all these things. I mean, I had a corporation since 2005, but I wasn't as savvy and I didn't know what I was doing. And I could have made a lot more money in my career and been a lot more wealthy than I am right now if I had the right guidance and the right people in my corner. So everyone should have an awesome real estate agent, an awesome tax person, an awesome lender, an awesome financial advisor, an awesome attorney, so on and so forth. And you build your team and then you grow your wealth. So thanks. Is there any last questions from anyone before Jesse jumps off? Because you have him here in the flesh and, definitely will help your pocketbooks. All right. Well, have a good night. What was that?
Does he help with 401k and retirement plans? Like,
Yes.
they use that money this year.
Yeah, we set them up all the time.
Yeah.
Okay.
So any of those needs, just hit him up. He'll take care of you. And then please leave us a 5-star review. Name your favorite realtor that invited you and thank them. Picked up the phone, call them and thank them. So appreciate you guys. Thanks, Jesse. Thank you, Claudia. Later.
Have a great night, everybody.
Good night, good night.
Thanks.